Good morning and welcome to everybody here at the Hotel George, and welcome to everybody across the country who are watching us through webinar. Welcome you to the first crowdfunding conference held in the nation's capital. I'm Sara. I'm CEO and co-founder of CrowdCheck, and in addition to all of our great panelists and speakers, I'm joined here by my two co-founders, Faybrooke Knight and Ryan Knight. As some of you know, CrowdCheck was born from a series of discussions about promise and the perils of crowdfunding. Crowdfunding, in essence, of course, is the small businesses raising capital by selling modest amounts of investments in their business to a large number of investors. This could fill a vital need for small business growth. We all know that small businesses are starved for capital. We all know that they're underserved by the formal financial sector. Everyone knows the refrain, the banks aren't lending, right? Who better to help small businessmen than the people who they know, their friends and their neighbors and people who believe in them. But with this opportunity comes the potential for fraud. These offerings are too small for the typical gatekeepers and guardians to be able to pay much attention. The sums involved don't attract much attention from the big investors and from the law firms. The regulators aren't set up to vet every single offering. Companies like CrowdCheck are going to fill this gap. We perform due diligence on companies seeking crowdfunding. That gives small businesses a chance to show they're legit. It gives crowdfunding investors the opportunity to avoid fraud and make an informed investment decision. We'll be addressing both of these things, the promise and the peril, on our panels today. In both of the panels, we'll also be talking about how we can leverage the wisdom of the crowd. There's a lot of talk about the need for investor protection, and that's certainly true. But it's wrong to treat crowdfunding investors as if they were just a gullible source of funds to be bilked out of their retirement money. There's a lot of wisdom in the crowd. We co-founders have been struggling to explain to our parents exactly what we're doing. Faye's mother hit the nail on the head the other day when she said, you know, older people would welcome the chance to give a small business a chance, even though there was a risk that they lose all of their money, so long as they knew that the business was a legitimate one. And that's such an American attitude. We want to give everybody a chance to do well, providing they play by the rules. So where are we now? We are waiting for the SEC to put in place the rules that will make investment crowdfunding a reality. If the crowdfunding fairy came to me and granted me 3 wishes, and I know there's some people in the audience and watching us on the web who are in a position to do that, this is what I'd like to see. First wish, let's use crowdfunding as the way to build a better investor. Let's build a better investment culture. Crowdfunding is going to bring more investors, younger investors, more diverse investors into the capital markets. Let's teach them to do it right. Let's teach them to use their judgment. Let's teach them and use them as the first defense against fraud, not just at the crowdfunding level, but also at the point where they can defend themselves and identify and avoid the Bernie Madoffs of this world. As we're going to see in the first panel, crowdfunding will let people start their investing lives at a local level. They'll be able to start with something they know, a person or a product that they believe in. They'll learn the difference between failure and fraud and learn to manage their expectations. They can take the lessons they learn in crowdfunding and apply those to more ambitious investments. Second wish, let's not gag the crowd. As we're going to see in the second panel, avoiding fraud is going to depend on a matrix of several different things working together. In addition to more formal types of fraud prevention, we need to let the crowd have input. Let the pros comment, let the rabble comment. It's going to be chaotic, it's going to be noisy. We're going to have to manage the crowd commentary in some ways to prevent libel, self-promotion, and political punditry. And we're going to have to filter the noise. But we need to come up with a way to leverage the distributed diligence that the crowd can provide. Third wish, we're going to have to develop some industry standards for information and processes. Crowdfunding by its nature is a massive thing. So processes, which could, for example, be investor accreditation and monitoring, and information, such as databases of businesses seeking crowdfunding, they're going to have to be both scalable and simple, and they're going to have to work across multiple platforms. The investor and the regulator are going to need to be able to filter and sift information. And all of us, intermediaries, business providers, platforms, we're going to have to work together to make those processes work. Speaking of working together, we at CrowdCheck are happy to announce that the first crowdfunding portal to use our services is going to be earlyshares.com, represented here by Maurice and Lopes, who will be speaking on this panel. We have a great program for you today, and I'd like to hand you over to David, who will introduce the panelists on the first panel. Thank you, David.
Thank you. I'm David Marlett, the Executive Director, Chief Bottle Washer at the National Crowdfunding Association. And I'm very, very pleased to, I'll let our panel introduce themselves. One thing that I'd love to add, first, I'm not too sure what leverage means, but I think you meant, I don't know, we in Texas call it leverage. But leverage.
Yeah, I'm a Virginia.
Leverage. No, Sara, I really appreciate you doing this, and I'm really glad CrowdCheck's done this. And at the National Association, we are moving very fast. I think it's one of the only times I was telling somebody that a lot of people are asking how we're going so quickly and why we're going so quickly. And it's hard pressed. I'm hard pressed to find another time where you have a law that literally introduces a whole new industry and regulations which are being written for that industry, when there's not anybody to sit on the other side of the table from the government. There's not anybody to, almost any other time you can think of, or some law or some new regulations that there's a pre-existing either associations or lobbying groups or whatever else to have a vested interest in seeing how those get done. So we've literally been, as the saying goes, learning to play the violin in the middle of the street. We have been moving very fast and very publicly, trying to get to that place. Because we need to work as an association at the same time that we're forming ourselves into an association. So I'm very appreciative of all the many people who have joined in to that effort. So without further ado on that, I will turn it to my panel. And today we're talking generally, what we're going to give you this morning is a kind of an overview of crowdfunding and what it is, how it works, and so I will just start with Sara. And then let's just do this. Let's introduce yourself first, and then we'll come back and talk more at length. So let's just first give an introduction, if you don't mind, Jen.
Sure. Thank you, David, and thank you, Sara, for the opportunity to join the panel. So my name is Raphael. I'm president of products at Avectra, and my role is basically focused on innovation and new solutions for the company. Avectra is, we label ourselves as a social CRM company. So CRM meaning constituent relationship management software or customer relationship management. If you're familiar with something like Salesforce, where you can manage customers, we focus on that for associations or charities. So we have 1,500 associations or nonprofits, which is why I'm David's new best friend, because we help associations manage their members, manage their constituents, help them build kind of a better relationship with the stakeholders of the nonprofit.
If you've ever seen a love affair happen right in front of your eyes, that's right.
So we're new best friends here. It's kind of like speed dating, networking or something. So we're social CRM. So it's combining the CRM aspects with the social aspects, because now managing your customers isn't just a transaction, or your constituent isn't just a transaction. It's a relationship, and you have to have an ongoing relationship with your stakeholders as a company, or an association, or a charity, to really kind of have sustainable value and create longevity with that user, because people don't just want a transaction with an organization or a brand. They want an ongoing kind of value add. So I focus on that for the organization. And we're also developing crowdfunding tools for nonprofits. Again, we have 1,500 nonprofits. We're headquartered here in McLean, Virginia, and about 200 different employees. And actually, I live in New York City. And sometimes when I speak, people are like, "All right, what's your background? What are you, I know you're in technology, but like, what's your cultural background?" So I'll give you a little quick family joke. My mom's Canadian, my dad's Egyptian, so that makes me a Egyptian. So that usually kind of lightens the mood of the crowd. Hopefully it's early, and and this is hopefully going to be a good dialogue and conversation. So again, thank you for having me today.
Good morning, everybody. Thank you, Sara. I sound a little, my bubbles deflated. I have a horrible flu, cold, and I spent the last 3 days at Disney suffering through 26 miles of carrying 3 6-year-olds, and I didn't get much sleep last night. I'm Maurice Lopes from Really Shares. We are a crowdfunding platform that was created basically because of the lack of opportunity businesses have to raise capital. That's why we're probably all here in the room. We basically, won't say invented this, but we conceptualized what our platform would look like about a year before this bill was ever written. We saw what was going on around other parts of the world and what was going on with non-equity-based crowdfunding, and realized that in some time in the future, we didn't quite understand it was going to be that quickly in the future, but we figured that sometime in the future, an equity version of crowdfunding would be feasible or legal. And we started building this, and thus, today we are probably one of the leaders in the space of equity crowdfunding. And we're trying to help everybody out with with David and Sara to get the right information in front of the SEC so they can make the right choices and the right regulatory rulings that will allow this to flourish into what will be literally the real game changer everybody keeps talking about, because businesses will have something they haven't had in 80 years, the ability to just raise money without having to go through a tremendous amount of red tape and costly red tape at that doesn't really allow them to do the process at all, which I'm sure we'll go into more. But good morning, everybody.
Hi, my name's Brian Knight. I'm the Director of Entrepreneur Services here at CrowdCheck. I was there at the inception and have moved so far up to the front of the room, and I'm happy to be here. A little bit about myself. I, like pretty much everyone else at CrowdCheck, I'm a lawyer. The difference being I've moved away. I've lived the dream of becoming a former lawyer. Prior to this, I worked at I started a company down in Austin, Texas that, like most companies do, just kind of didn't work out. And so I had my first failure, my first scar, and it's made me a lot wiser from it, and it's given me a real appreciation and insight into just how hard it is to start a company and get it off the ground. And prior to that, I worked as an attorney for the federal government and in private practice. But I got to say that once you actually get into starting something on your own and trying to make it work, the notion of going back is just ridiculous. So my hope is that crowdfunding is going to help more people do that, keep it going, and create a more diverse and vibrant sort of economic ecosystem in this country. So.
Thank you. All right. One thing that I wanted to first off talk, panel, about is how let's just talk about first sort of the nuts and bolts of crowdfunding, and then we can get into some of these others. But fundamentally, and Maurice, let's put you back on the spot. To talk a little bit about, as a platform, just give us a real quick snapshot. Probably most people in this room is a different kind of crowd here. I would assume most people in this room probably have a pretty good idea. But at the same time, let's just kind of walk through how you're anticipating it working with your platform. People, how they're going to get to you, how they're going to find you, and how are you going to be making money as a portal.
Okay. Well, we deal with the platform. When we say early shares customer, we really have two customers. We have the investors and we have the entrepreneurs. And uncommon to most people I talk to, they understand as entrepreneurs being a small business, startup, the guy with a napkin idea. And that's not our idea of an entrepreneur. Occasionally it might be, but it's usually the guy who has a patent or who just left IBM with a nice piece of non-proprietary technology that you can take with him. But most of the time, we look at those entrepreneurs, the ones we're looking for, and the ones we end up after our vetting process are really stable small businesses or even medium-sized businesses that are looking for cash. So it can be a startup, but the majority of the time, believe it or not, is that it's a small company that has $1 million, $2 million, $3 million in revenue, 5, 10, 20 employees. It just has absolutely zero access to capital for whatever reason, and there's a number of them. The SBA small business loan under $1 million, we're at 12-year low on approval rates. Just there is no loans, even though we have these great government incentives, like through the SBA, they just don't get. The banks don't want to take the risk on the other 20% is not covered by the government. On our platform, those two customers work very differently. See, it's easy because the people looking for money will find you. The people who put money, you got to find them. So our focus is really on investor protection. Our focus is on creating a safe, well-informed location for investors to find good companies to invest in, not just any company to invest in. I think it's much more important to find a nice portfolio of companies you can invest in that are sound and have been checked out through CrowdCheck and our own due diligence process and vetted through a number of analytics and business tools that we use, and we have a couple of other partnerships too that vet these companies with us. So it's not just our own review of these companies, it's actually, we use third parties as well. And when we put these people, the idea is that from a crowdfunding perspective, is that you put these two pieces together. You've got the investor, which is now a whole new class of investor, which is now every single person in America can afford to put in $100, who has that dream or that ambition to be the next owner of Facebook or Twitter, or in this case, it's even good enough to be the first one of the founders of Instagram. And we want to mash them together in a safe and cohesive way, and that's what we do as a platform. That explains what your question.
Sure, it's good. It's good. So fundamentally, as a platform, you're looking for, are you going to be open to whomever comes your direction? I mean, how are you going to decide between the people that are looking to raise money on platforms?
Well, Early Shares has a proprietary methodology of selecting companies, but we've given an example. For the last 90 days, we've received over 220 applications for companies, and we've probably selected about 9 or 10 that are in the second stage of our vetting process. So it's not very easy to get in. This is not a fix-all for all. Crowdfunding is not for every single idea out there, whether it's good or bad. It really is about just a different way of investing, and it's about making funds available to legitimate small businesses and startup companies that can have real traction, can have real product, can have real success, but just have no access to capital. Those are the ones we're looking for. So we're looking for companies that have the right sauce or the right recipe.
Okay.
I can talk about some examples if you want.
We'll come back. I know you can talk about the details. Yeah, I'm liking this version of Maurice. You don't know how lucky you are. No, he's great. Brian, from the investor's point of view, or from that side, what do you see as far as the different methodologies for getting into crowdfunding?
Well, I mean, I think Maurice brings up some really interesting points, which is that we're talking about a different class of investor than we've really seen in a while. I mean, your average person, most of their investment is through like a 401k or some other relatively passive vehicle where someone else goes and picks a basket of stocks or bonds or whatever, and then you may choose, I want to pick the risky one, I want to pick the less risky one, or something like that. But in terms of actual active investment, particularly in small companies, it's largely unheard of. And this, the investor, the beauty of crowdfunding is that it opens up to entrepreneurs a different group of investors that have different expectations than, say, institutional investors. They're going to have different motivations for why they invest and who they invest with. And they're going to have, there's going to be a different relationship between them. And so that's something that the crowdfunding industry and entrepreneurs who are seeking crowdfunding are going to have to be mindful of, is that it's not going to be as simple as someone putting up a post on a profile or on a portal and saying, "Hey, give me some money." You're going to be talking about people who.
That's called Kickstarter.
Well,
Actually, no. They've read out about 80% of their
I
money.
know.
Yeah.
It just seems like it with all the money that's flowed through.
Right, but it's interesting you bring up Kickstarter because if I could sort of differentiate types of investors here, and this is in very general terms, you have Kickstarter donation investment on one end of the spectrum and VC on the other. And venture capitalists, they want a scalable, profitable, multiples of their investment profitability. And part of that is they have different obligations. They have people they answer to about their rate of return. And also, they're going to have they have a portfolio of companies they invest in, some of which are going to fail, and they're going to just lose their money. So they need a high rate of return to compensate for that. On the other hand, you have Kickstarter, where people invest. They don't invest; they donate because they enjoy the notion of living in a world where this thing exists, and it's almost a pure psychic benefit. Whereas crowdfunding falls in between. People are going to want a return on their investment, but they're not going to need a 50-time return to compensate, to justify to their shareholders or their partners or whatever. They're also likely to vote or vote with their dollars, if you will, in things that strike a chord with them beyond just the rate of return. So local, we were talking about local, or a sector like, for example, green technology or something where they were like, I want to live in a world where this type of company thrives. Or areas where they can appreciate, I need a 5% return on my investment. So things like manufacturing or service, which are all too often kind of ignored by institutional investors because they're not perceived of to lead to that huge scalability, it becomes a viable investment. So I think that's something that crowdfunding both offers, but also something that we're going to have to manage, and manage expectations and create a system where that type of investor can get in without either being just sort of thrown off on their own to the wolves or frozen out because they're not as sophisticated as, say, a VC.
Okay, thanks.
Oh, I'd like to add.
Yeah, go ahead.
Does anybody here in the room does not know what Pebble is? Somebody doesn't know what the new Pebble is? Two people? Okay, I'll do the quick. Three people. All right, this works. All right, Pebble was a project that was launched on Kickstarter, I think about 17 days ago now, roughly. And it's basically a short time. It's a watch. Okay, it's a very fancy watch. There's a lot of cool things. Everybody wants one, right? I bought 5, by the way. It reached $10 million in 11 days. It reached $1 million in 6 hours. It reached $5 million in 3 days. And this was donation-based. 56,000 something people as of Friday basically pre-ordered a Pebble before it's even made it through the first assembly line. So that company is already successful, in my opinion. But the reason I wanted to mention it was that something that Ryan said was actually quite interesting. People donate or invest for 4 reasons, and we heard this in New York. So I won't take the credit for it. I heard somebody else say it. But it was, number one was they want to feel good about what they're giving away their money to or investing their money. Number 2, they want a sense of community. They're doing something because they want to be part of something bigger than themselves. 3 was the perk. In particular, most of these non-equity based donation projects, there's always a perk usually. And that might be a free T-shirt, a copy of the CD. In this case, it was one of the watches. And lastly, it's usually a return on investment. So they're getting something back on their money. But it was actually interesting to find out that statistically this was the last, not the first. And to that point, what Brian was saying was, I got the weirdest email, I think it was on Thursday afternoon, from one of my staff, because we actually ran a competition. We wanted to kind of leverage off of Kickstarter's Pebble success, and we ran a competition called freepebble.com. So you went on freepebble.com and you guessed what the number would be at the end of the funding. We would give you one of the Pebbles. Well, I got this really strange email on Thursday saying, what do we do now? I'm like, what do you mean? There's like 11 days left of the no, it's over. I'm like, what do you mean it's over? They sold out. they literally sold out every pebble that they put on the site. So the way Kickstarter worked was you had a certain number of offerings per those perks. So there was 5,000 of these, 10,000 of those, 10,000 of those, and so they sold out. They filled out every single one, including 30 of the $10,000 donations, which got you 100 pebbles. But the cool part of the story is not that. The cool part of the story was that even though they sold out and people could no longer get a pebble, the number was at 10,142,000 or something on Thursday. I believe it's up $100-some thousand since then. Well, think about it for a second. There's another $100,000 of money given to Pebble without any return whatsoever, without a watch. This was the last 100,000 that's on the site in the last week or so. They're basically just gifts, like saying, "Oh, you know what? We think you're doing something cool. Here's $10." I mean, they're not getting a watch in return. They're not getting a T-shirt in return. They're not getting. They might get a thank you email. That's about it. The other $10 million came from somebody actually getting a perk or getting a watch.
You know, I was going to interject on this, and that's a whole other discussion. Is we keep using the word donation, and I think we've long left donations,
Right.
And we're into pre-sales, which is this whole.
Right.
It's got its own hair on it. I mean, it's got its own issues that need to be dealt with, but. I mean, it's going to be interesting. So, to one way of looking at it is that we've already been doing crowdfunding, and it's actually a return on investment. Your return's called a watch,
Right.
And in that sense, but you're not an equity holder, stakeholder
Right.
at the end. So there, obviously, is the difference. Let's talk a little bit about, from your point of view, of there's a lot of other social. At the National Association, we've recently launched an affinity group where we're trying to bring some of the nonprofits and other associations together. Because there are already sort of micro crowds and have a commonality, and helping them bring crowdfunding to their members. Tell me more about what, Sterling, from your point of view, of other ways we see crowdfunding being socially beneficial.
So when you think about associations, they're kind of like before social networking was all online, the original social networks were associations, right? You have people getting together, networking, marketplace, exchanging ideas and information just in real life. We just think it's all revolutionary that it's now online, but it's really just associations and communities now online, just like associations been doing for years. And in terms of decision making, crowdfunding is a way that associations can make better decisions and innovate industries using crowds, not just their members, but the people that are represented by the members. So one of our customers is Rotary International. And we're partnering with them. Everyone knows a Rotarian. There's 33,000 clubs worldwide, 1.2 million members, and they're very service and philanthropic oriented, and they really focus on, doing good for the world. And what better to do good for the world than to kind of crowdfund different projects and service-oriented initiatives using, these kind of social decision making. So as opposed to, Rotary Club in Zimbabwe trying to, figure out how to make a well system, in their own way, they can put their project up there and say, we need, $50,000. But it doesn't stop there. They also need, people to donate time and people to give resources, a truck, a well rig, or people to connect them with the right politicians or companies to get approval for different things. So for Rotary and other associations and nonprofits, we're not just helping them crowd funding, we're calling it crowd contributing. It's not just money, it's time, resources, and connections.
Crowdsourcing is kind of been also.
Yeah, and it's not, but you're not just saying I vote on something, I'm not just giving you input. I'm pledging and donating my time or my resources or my connections to help an initiative get done. So the club in Zimbabwe can get the club in Dallas, New York, and Orlando to offer different connections, time, resources, or money to help fund that project. And the number one reason people don't re-give or re-donate or re-pledge to a nonprofit or an association is because they get that initial high when you give something to something for good, you get a good feeling. But if you don't stay connected to that cause, if you don't follow that and see that money go to a tangible results and know that it actually went for good, you may not re-give, and that's what they found is the reason people don't re-give. So crowdfunding for nonprofits and associations or any industry really allows the marketplace or the constituent base to crowd decide or direct, what either innovation or results the industry or cause needs to happen for the better of the market as a whole. So it's not just the members who show up at the event or the top donors who give their $100,000 check.
Right.
It's the entire industry or entire constituent base that gets to collectively decide where things go. And I think that makes things more efficient at the end of the day.
Well, that's what, as we've gotten further along in this, you see that crowdfunding, really there's nothing, it's funny, as interestingly, but there is a lot of things new about this. It's really exceedingly old as far as human nature is concerned, and I'll won't pontificate my own opinions on those things. But I do think that we've got a lot of commonality here, in the sense of anytime you've ever gone out and tried to raise money for a particular cause. Now, since we're talking about equity, do you see a bridge between? I mean, that's one of the issues that I know we've been working on is how do you give an equity stake in something that's a donation, and bridging that, finding a way where people can, in other words, these associations or all these other groups,
right.
they want to use it to raise money, but if they raise money, it's more of a donation side. There's nothing really there.
Well, as Maurice said, it's not just about ROI. There's a lot of other reasons people write a check, or give money, and it's to stay connected, it's to have affinities, to be part of a community. Is to feel good. But actually, associations and nonprofits, they're not, nonprofits doesn't mean non-money. There's a lot of nonprofits that do billions of dollars worth of revenue.
Right.
And that money is for good, but there could be some perks and returns on people getting something back for their investment. Think of a silent auction, right? You're giving money, you're donating, it's going for a good cause, but you're getting something back.
Right.
Crowdfunding for nonprofits can also give you a return or a perk, let's say, some kind of value on your donation, and you can get something back, but you're also going for a good cause. And there's that, different types of corporations now, social good or social entrepreneurship organizations that can be not so for much profit type of organizations that can get a better tax status and things like that. It's you may know the type of corporation. It's not a C Corp, I think it's a B Corp or something.
So, well, there are a lot of, and we're working on, for example, working with municipalities, for example, which is sort of on-ramps into this. So it's sort of a hybrid government, public and private initiatives where it's not really private for them. It's about helping their community. So there, you get these extra steps. And one of the things that I find so fascinating, just in the short amount of time since the firing gun's been started on this, is the amazing number of innovative ideas that people are coming up with how to participate in crowdfunding for themselves. We talk about a Jobs Act. I think right now it's just creating jobs in servicing crowdfunding. And it's fascinating that also there's a lot of innovation right there in how to do that.
And actually, I had a question for Brian.
Sure. Yeah, no, no, go ahead.
No, it's being a lawyer and a founder, it's now even being increasingly easy to get funding for a good idea, especially with crowdfunding. But doesn't that create a bubble, in terms of the next round? Because it's easy to get quick money, and it doesn't take a lot of money to start a new idea, but that Series A or that after the angel round, there's not a lot of money out there for that next step.
I'm glad you asked.
That's
Well, I mean, that is an issue that needs to be considered, and companies seeking crowdfunding, there's no such thing as free money. And so when you are considering whether or not to seek crowdfunding, you need to think about how this is going to set you up down the road. If you are the type of company, if you're a stable, mid-sized company in an industry where there really isn't a lot of VC or anything like that, and you want the crowdfunding to achieve a burst of capital, to buy a new machine or hire some new staff to continue to expand, then crowdfunding, the risk on crowdfunding is probably fairly low. But if you are a brand new company, a startup, or something like that you think you might want to pursue institutional funding down the road, you need to plan for that. Because if you show up to in a VC's office, I got 10,000 investors and they all own $10, the VC is going to look at you funny, because you just complicated their lives and you've added a lot of uncertainty. And as crowdfunding becomes more mainstream, institutional investment will adjust, and there will be off-the-shelf solutions and legal structures that people can pick up and with some tweaking move forward with. But right now, you're absolutely right that people need to be mindful of what is this going to do to me down the road. And you're going to see, I mean, the danger is you're going to see a whole bunch of people invest a whole bunch of money in someone with a good idea and then it never goes anywhere, and it sours the community on crowdfunding. So that's something investors need to be mindful of, and it's something entrepreneurs need to be mindful of, that it may not be worth getting that quick jolt of $100,000 right now if a year from now you're either having to go right back and explain why this last raise wasn't sufficient to get you to revenue, or go try to find that next burst of funding and find that it has disadvantaged you. And one thing I wanted to mention, because we're talking a lot about, and I'm going to use them as a verb and hurt their IP, and well, too bad they should have been in the room, but kickstartable projects, right? Projects that work on Kickstarter or that type of thing, things with a high social component, things which trigger that pleasure sensor of, oh, I'm doing something good, or oh, I'm seeing a thing of beauty. And those things are wonderful, but we have, one thing that we have to remember is that a lot of people have a lot of companies that can produce a lot of jobs in fields or industries that are frankly kind of dull, right? Important, useful, necessary, good jobs, all that, but not exciting on a web page. The widget maker or whatever.
Catering company.
Your catering's fantastic. Yeah, or a catering company per se, to use as an example, and that creates a problem, because if investors are going to be drawn to sort of the bright, shiny, ooh, this is aesthetically attractive, or ooh, I can spend some money doing some social good, that's money that's not going to help build small and medium-sized businesses and put the jobs in the Jobs Act. And we have a question.
Yeah, before we go to questions real quick, I was going to say, I'm coming to you. I know. Maurice, I got you. But one of the things that I was going to ask you, and then you go which direction you want, and then, by the way, after we will throw this open to questions, so have your questions ready. But what are you seeing as far as, can you talk a little bit about the limitations on, you're talking about different kinds of investment, but as a portal, you have very strong limitations with regard to what you can do as far as advertising those things, or benefiting, what you can do to support those. I'm looking at you, Mr. Portal. Yes. Can you talk a little bit about that, because he's talking about the different types of...
Well, I'll start off by saying that it's all up for interpretation right now still. Even though there are some very strong guidelines in the bill, the SEC really has a lot of leeway, as Sara often mentions, that they have quite a lot of discretion based on some of the verbiage on that to make significant changes in that. So I wanted to address, I don't necessarily know what the answer to that would be yet. We're looking, we talked to some of our attorneys say, you'll be able to put tombstones of every company out there, but you can't showcase or feature one company a day. Other attorneys say, well, you'll be able to do the tombstones in a newspaper, but you can't offer the amount of securities in a newspaper. Like, you can't say, like, the tombstone being 1 million shares at $250 or 100,000 shares at $250. So the actual advertising component of this will actually still be to be determined by the SEC, I think. And hopefully a lot of these comments that the SEC is getting will help them make that better judgment. I wanted to address what Brian said, and I will say not all platforms are alike. And again, this will be subject to SEC. There's no doubt in my mind the SEC will kind of put in some sort of guidance in reference to how these structures, how the legal structure of these companies will have to be. With that said, on our platform, we specifically are looking at how not to hinder startups' ability to raise capital in the second round, third round, whatever that may be. And we've dealt that it's not really that proprietary, anybody can do it. Is we package the investors in a separate holding company, and that holding company owns that stake in our company. Therefore, when they go in front of a VC, they only really have, let's say it's a two-family, it's a two-member company. So they have, the two owners of the company and a third vote, which would be the group of the 1,000 shareholders in that LLC or that corporation. And they're still, again, it comes down, that's our idea of our structure, that's the way we've built our documents, but it's not necessarily the way it might end up being, because the SEC, again, can turn around and say, no, your interest has to be directly into the entity, or no, your interest can't be in a holding company, or can't be in a separate LLC. But there are some advantages creating it correctly, and I will say this, that the different types of platforms will have different structures, and some will have less attractive structures for investors and more attractive structures for entrepreneurs.
And that's the thing we're seeing is that there's platforms all across the country that are popping up all over the place with ideas of different methodologies. I need to throw this to questions, and in a few minutes. Yes, sir.
I'm Bill Cunningham from MinorityFinance.com. So we registered online. We're focused on women and minority-owned companies. Site created in 1998. And every day since July 11th, 1998, if we look up the Who Is record, every day since then, we've gotten at least one inquiry from a woman or a minority-owned company looking for capital. I'm not sure, my question is, why is all of the focus on fraud? Because what we've seen since 1998 is that most of these people that are emailing us, and your point about boring companies is spot on. Because we're getting emails from people who want to run daycare centers, want to buy the restaurant that they work in, want to buy the auto shop that they worked in for 20 or 30 years, but just don't have money, and have gone to banks, and of course, have gotten completely blown out. So J.P. Morgan loses $2 billion, and you guys are worried about somebody getting ripped off for $1 million. There's a disconnect there, which I wonder if you can speak.
We're not worried about anybody.
You may want to repeat the question for the audience.
So, if I understand your question correctly, you're wondering why there's so much concern about fraud in the crowdfunding space, where, in your experience, you've seen a lot of honest people who want to begin an entrepreneurial process but can't get access to capital. Meanwhile, obviously, there's a lot of big money being lost.
And I know, and I'll say this real quick. I know our whole next panel is going to be talking about fraud, so I don't want to get too far down this path, but not to miss your question. But
to answer your question, or try to anyway, I think the concern is that if you were having someone every day from 1998 coming at you to try to do this, there's every reason to believe they were legit, because there's no avenue for sucking up a whole bunch of money via fraud until now. But we've created this avenue, and there's going to be a lot of good done. But if you create a means to get a whole bunch of money from a whole bunch of people all over the country, basically via the internet, like every other thing that like every other time there's a threat, you're going to see fraud. And the concern is, at least my concern is, the fraud is disproportionately going to hurt the type of people who come to you, because it's going to sour the well of crowdfunding. If people view crowdfunding as, securities-based crowdfunding as, wow, it's the Wild West, and you have a pretty good chance of being taken by fraud, it's going to close up, or the government is going to come in and regulate it to the point of death, and that's going to cut off a potentially very valuable source of capital for the type of people who come to you. So the concern about fraud is more to protect people like that, rather than any sort of distrust.
Yeah, and I think that's what Bill's saying. I think he agrees that why shouldn't we be able to do this without worrying too much about fraud? And it's not like there's not a lot of fraud in our traditional finance system. I mean, come on. But think of eBay, right? eBay's got a reputation. The more you use it, the better reputation you get, and the more you trust people. So you actually have to build trust online. So if you got a brand new company who's never been crowdfunded before, a brand new investor who's never invested online before, you're going to be more skeptical. But the more you do it, the more you're successful, the more you'll earn the right to do it more, and the more you'll get followers and a kind of a viral reputation. So I think you have to almost grow and earn that. And the more you as a and there's company like CrowdCheck and things like that will help validate it. But I think it'll continue to grow, and there'll be more online reputation based.
Right, and I know the next panel is going to be talking a lot about that very subject. Other questions? This is, yes.
I had a question. Maurice, I'm Alex Alpha from Reuters. You had mentioned this issue of like the SEC writing all these rules, and it's important to get the right information in front of them. So I guess which rules, I mean, if you could kind of walk us through the rules that the SEC has to write given this law, and sort of what you see as the big fault lines, like your concerns about the direction they may go in and what you're hoping they'll end up.
You know, if we could, because that literally could take a lot of time.
Get it offline.
Yeah, if we could, I would love to. We'd love to visit with you.
That is a long.
Yeah, that's a long one. I'll take it real fast and just simply say that we're working. For example, we're meeting with the SEC this afternoon. There are numerous issues with regard to portals and their profitability and squeezing them with regard to how they make money and how much requirements are on them. Sort of the investor groups, who's an investor, limitations on those sorts of things, and a lot of the detail stuff as far as how these transactions can happen and how to. Our big interest, I know, from the association's point of view, is we share, I know, with the SEC a very big concern for protecting those smaller investors and protecting their money so that they don't. That's what will make this really work when people do feel like they're not. When the shysters get them on the phone and try to talk them out of another $2,000 or whatever it is, we want to have those blockages in place, but they just can't do that. So they get to participate, but there's a safety there. So a lot of these little points, we can talk more specifics. Any other questions? Yes, sir.
From a diligence side, I almost see sort of two halves here. You've got the business side of what are the risk factors that apply to this company, and then call it a disclosure and a legal side. If you guys wouldn't mind talking, probably the most appropriate would be from the platform and from the government. Where are you guys sort of seeing as the key things that you guys are focusing on for each of those two halves, and are you really trying to do both?
I think I'll repeat the question. The question was, from a platform perspective, are we looking at not only the failure rate or the success of the company or the quality of the company, and as well as the legal disclosure portion of the investment side of it? So failure versus fraud.
As well as sort of the risk factors in the front of the prospectus. Maybe another way to shortcut that.
Sorry, can you?
Are you trying to be ISS, institutional shareholder services, that will opine on the governance of the company and sweetheart deals for CEOs? And are you also trying to describe the front half of the prospectus and the risk factors there?
Are you neutral, or are you?
Yeah. Again, this is one of those things that's kind of up to the SEC at this point. I can tell you that, again, on early shares, we have a very stringent vetting process, which includes CrowdCheck for the fraud perspective of it. And on the business due diligence portion of it, we vet out, I'd say 95% of the deals based on the business algorithms that we've got in place. So we look at a business, we look at management team, we look at traction, we look at product, we look at market share, we look at, look, the successful portals are going to be the ones that act like VCs. The difference here is that instead of raising millions and millions of dollars, you're raising hundreds of thousands of dollars for these small companies. And you're allowing the general population to be part of that VIP club that weren't part of before. The non-accredited investor. With that little $100 or $250 or $500 contribution to that company, which they may or may not get a result out of. That's another thing. There's more. It's easy for me to look at this and say, well, there's a lot of, answering your question, there's a lot of concern about fraud. Where I'm more concerned about success. We want to see successful companies graduate the program more than the 100% elimination of fraud, because you're never going to eliminate 100%. You're always going to have that 0.0001% or whatever. But the fact, the nature of our business, and again, we'll draw the next panel. We'll talk about fraud, but just something to think about. The nature of crowdfunding is only enabled because of social media. I mean, if you didn't have social media, this really wouldn't work, right? I mean, that's pretty much why it's been born. Right? If you couldn't spread the word about that fairly easily, there would be no crowdfunding. And the fact that it's social media, you're kind of your own connections, your own people are the ones vetting out your process. I mean, the panel we were at together last week in New York, or 2 weeks ago, the lady from Indiegogo made a very good point. She said that there's a tipping point on every project, which is about 33% roughly, and until they get to that number, the general population doesn't jump in and feed the fishbowl with money. Okay, so with that said, and then I was thinking about that, I was like, wow. And her comment was, we have less than 1% fraud. And I said, wow.
I think that's the important thing, and I really want to leave the fraud issue for the next panel. But the fact is that there is a lot of tools we're going to see coming to the marketplace, which will, by their very nature, in other words, we're working right now in association with community banks, and we have an initiative called Crowdfunding Local, where we're bringing community banks and municipalities and et cetera together to sort of dress their local communities, companies up before they go out on the portals. And so by doing so, it not only does it help the municipality, helps the business, helps the citizens feel like they're investing in their own community, there's also a bit of vetting goes on there. I mean, it's a lot harder for the fraudulent to get through that door. So there's we're seeing a lot of interesting things coming along, which by their very nature, not only help the parties, but also help reduce some of those things. And the only thing I was going to say, I know what you're talking about as far as those front disclosures, but that's also part of the legal side of this, that as far as investors concerned, they're going to be basically saying, I realize, my odds are that this business will fail. And that's something that's going to be very proactively put at the beginning. And the detail of that are yet to be worked out, but I know that's the general thrust. Do we have time for one more question? Okay, one more question. Anybody? Well, I really appreciate the panel coming. This is a subject that we can talk. Really, there's so many interesting layers to this, and so it's really difficult to really hit it this quickly. But I know a lot of us will be around afterwards, so we'll be more than happy to talk with you later.